Something rare is currently happening to Mastercard that hasn't happened in over 5 years. You see, Mastercard is actually trading at one of its cheapest valuations in the last 5 years. Now, you might be asking, how could that be? The stock is currently up about 75% in the last 5 years. Well, it's actually pretty simple. Free cash flow and earnings have been growing at a faster rate than the share price of the stock, driving the valuation down. Let me show you what I mean. If we look at the price to cash flow valuation for Mastercard over the last 5 years, we can see right now it's sitting at about 28.4. 28.4. That's the cheapest we've seen in the last 5 years, with the exception of a brief couple of days in late 2022. Now, what's perhaps even more interesting about this is if we compare them to their counterpart Visa. Visa is a stock that I own in my personal portfolio. Mastercard is now trading at a lower valuation than Visa for the first time in, again, about 5 years. Now, Visa is a stock that I own in my personal portfolio. I believe it's my second largest individual holding, and I've been quite happy with the performance that I've seen from this stock. And like we just saw, again, the valuation of Visa was considerably cheaper for the majority of the past 5 years, but we've seen this valuation gap close and even flip. Now, why would this be the case? Well, let's dive into this just a little bit more. One of the things we can do is look at the stock comparison sheet. Let's look at Mastercard versus Visa. The data will load into our spreadsheet, and like always, if you'd like to be able to download any of these sheets and get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now again, what we're trying to find out is why did Mastercard trade at a higher valuation than Visa for all these years? And there's a couple of different things we could immediately point to, such as the fact it looks like they were growing top lines like revenue faster. Looks like they were growing free cash flow at quite a faster rate than Visa over the last 5 years. Now, we have to remember multiple valuations when we're looking at price to earnings multiples, price to cash flow multiples. By themselves, they don't tell us anything without actually accounting for how fast the future cash flows and earnings are going to grow. Stocks that are growing earnings faster warrant higher PE multiples. And so that was exactly the case for Mastercard. That's what we've been seeing for really almost the last decade now. But here's what's so interesting about this. The valuation gap for Mastercard and Visa, yes, it's flipped. But look at the projections for Mastercard and Visa's earnings over the next 3 years. According to the average analyst estimate, Mastercard is projected to grow earnings at about 6.4% and Visa now around 12.5%. So not only is Mastercard now trading at a lower valuation multiple, at least with the price to cash flow multiple, they're projected to grow earnings and cash flows at a faster rate than Visa in the future. This is what's so important that we need to make note of. So does this mean Mastercard's an opportunity? Let's start to dive into the fundamentals just a little bit more. To start, let's take a look at the dividend metrics. We can see Mastercard, yes, quite a low starting dividend yield, only sitting at about 0.55%, but just phenomenal dividend growth over the last decade at nearly 17%. Look at this, going from 44 cents per share in 2014 to about 264 in 2024. And perhaps what's most impressive is during that time, even during rapid dividend growth, the free cash flow payout ratio is still sitting at only 17.11%. In fact, the free cash flow payout ratio has pretty much been in that 15 to 20% range for the entirety of the last decade. The only way possible for a stock to grow dividends at an exceptionally high rate without the free cash flow payout ratio increasing is to grow free cash flow at a high rate. And that's exactly what they've been able to do, and like we just saw, that's what they're projected to continue to do. 2014 was about $3 billion in free cash flow, 2024 over $14.3 billion. If we jump over to the stock screener, we can see this company has quite a few characteristics that make it quite attractive. And really, this is what you could call a capital-light quality compounder. What do I mean by that? Well, there's a few different things we can point to. Number one, look at return on invested capital. What type of returns is the company getting on the investments they're making internally with the business? Typically, as a baseline, we want to see at least 10%. High-quality companies will get probably above 20%. Well, Mastercard is consistently above 30%, and the last 3 years have all been above 40%. If we jump over to the profitability sheet, look at those profit margins. Last year's gross profit ratio, 76.31%. And then if we jump over to the free cash flow analysis sheet, this is probably one of the most impressive things about Mastercard. Look at the free cash flow analysis. There's plenty of data here, but what I really love to point out and pay attention to is the free cash flow margins. What is this telling us? Well, it's essentially telling us for every $100 in revenue that the company generates, how much is actually becoming free cash flow. How much makes it all the way to the bottom line. And in 2024, that number was 50.79%. So think about that. Every $100 of revenue the company generates, $50 to $51 is finding its way all the way to the bottom line and becoming free cash flow. That's absolutely amazing. That's a very high free cash flow margin, but on top of this, look at the improvements in free cash flow margin over the past decade. They started about 32 to 38% from 2014 through 2016. They gradually increased until they got to above 50% in 2024. Now, this is worth noting for a few different reasons, because if we look at the revenue growth, it's sitting at about 11 to 11.5%, whether you're looking at it on a 5 or 10-year basis. But if they're growing revenues at a double-digit rate, and at the exact same time the free cash flow margins are expanding, it allows them to grow free cash flow at a substantially higher rate than just the top line growth. That's how free cash flow can grow so much faster than just revenue. In fact, this type of operational efficiency is something I was talking about over on Dividendology.com just the other day, and the example I was using in that instance was actually Visa. If we scroll down, take a look at Visa's 5-year growth rates over a specific time period. We can see gross profit was growing faster than revenue, but operating income was growing faster than gross profit, net income faster than operating income, free cash flow faster than net income, and free cash flow per share, which is the ultimate driver of intrinsic value, was growing faster than free cash flow. How does this happen? Why would this be the case? Well, you have to understand how they're all interlinked together and how they can improve at each level. So, for example, yes, we understand the importance of revenue growth, but look at this. Gross profit can grow faster than revenue because high-quality companies can expand their margins over time. And this would be an example of pricing power. And that's something that both Visa and Mastercard have a lot of. Visa can raise transaction fees and expand into new services without losing customers. If we keep scrolling down, operating profit can grow faster than gross profit. This essentially happens when the company becomes more efficient, such as reducing research and development, sales, and administrative costs relative to the revenue that the company's bringing in. Each new dollar of revenue becomes more profitable. But we can take this even further. Free cash flow can grow faster than net income. When does this happen? Well, it happens when they can reduce capital expenditures while maintaining growth. And because, like I've already pointed out, Visa and Mastercard are both very capital-light businesses, healthy debt-to-assets ratios, this is pretty common for them. And then free cash flow per share, the ultimate driver of intrinsic value, can grow faster than free cash flow because stocks can buy back their own shares. And if we look at Mastercard, we can see they've done a lot of that over the past decade. In 2014, they were sitting at about 1.16 billion shares outstanding. 2024, they're now about 925 million. What we just saw is an amazing case study, and it's a great example of how, in the case of Mastercard, revenue can grow at about 11.5%, but free cash flow can actually grow during that exact same time period at a substantially faster rate, 16.6%. This is why I love capital-light compounding companies. Now, let's take just a minute to actually talk about the valuation for Mastercard. They just recently released their latest quarter's earnings. And if we look at net revenue year-over-year growth on a quarterly basis, it grew by about 17%, or currency neutral, around 15%. If we look at adjusted diluted EPS, it grew by about 13%, or 11% currency neutral. But just as important as the results they actually posted is perhaps the outlook that they gave us moving forward. They stated that the company expects year-over-year net revenue growth to be at the high end of low double digits range on a currency neutral basis. Now, essentially, that's a fancy way of saying revenue will probably grow around 13 to 14%. And like we've already seen, that's actually even faster than we've seen over the past 5 and 10 years. So without needing to dive too deep into the financials of this recent earnings report, you can see overall it was pretty solid. But regardless, the stock is still down about 3% in the last month and has definitely lagged the broader market year to date, only up by about 5%. So what type of forward-looking returns can we expect for Mastercard at their current prices? Well, to answer, let's go ahead and jump over to our sensitivity analysis model. Now, to project future returns, there's 2 variables we need to apply, and that's our EPS growth rate along with the projected PE ratio for the future. Now, what we can see is we have the next few years of analyst projections. Again, this is one of the cool features of ticker data, automatically looking at the average analyst estimate when it comes to earnings per share. And, Mastercard's projected to grow at a pretty rapid rate. So by 2028, they believe EPS will be around $26. So how fast... So that means the projected EPS growth rate is around 16.5%. That puts them at 2028 EPS of around $26.07, right at what the average analyst estimate is. So what's the projected PE ratio that we should apply? So what PE ratio should we apply? We've already seen that they're trading at their lowest price to cash flow multiple in about 5 years and now lower than Visa, but even on a price to earnings multiple basis, they're still trading below their historic average, but not by a large amount. So let's be more conservative with our analysis. Even though they're growing earnings at a fast rate, let's assume that the PE multiple falls back all the way to around 32. What type of returns would we expect? Well, we can still see by the year 2030, we're getting double-digit returns and a compounded return of close to 13%, not including that dividend, which will grow at a high rate. Even if we pull the PE multiple back to around 29, we're still looking at market-beating returns. If it gets down to around 26, still beating average market returns, and even if we apply 25 multiple, still beating average market returns. So the reality is, if they can get even close to what analysts are projecting for future earnings growth, then Mastercard has certainly become a more attractive long-term opportunity. The EPS projections from analysts look quite attractive. The recent earnings report certainly was in line with what we want to see, and the outlook that management gave us was quite good as well. So it's actually pretty exciting to see the valuation multiples for Mastercard start to fall. So let me know what you think of Mastercard in the comments down below. And again, if you'd like to download any of these spreadsheets to get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.